Welcome back, junkies. It's Brandon Dukeman here along with Will Harvey, and today is Multifamily Monday. Thanks for joining us for our daily episode on the Wealth Junkies. Before we get started, don't forget, subscribe to the show so that way you're not missing any of our daily episodes and any of our Multifamily Mondays. And with that, I'm going to let Will introduce our guest for Multifamily Monday.
Thanks, Brandon. Today on the show, we have Jeremy Roll. So Jeremy is a full-time passive cash flow investor. He mainly
The good stuff.
Yeah, that's right. Cash flow. He mainly invests in commercial properties, and he's been full-time since 2007. However, he's been investing since 2001. He left his corporate job in 2007, and he's got an awesome story. Right now, he's the president of Roll Investment Group, where he helps others do what he's doing. He's also started a nonprofit, and it's FIBI, for investors, by investors. Is that right, Jeremy?
That is correct.
All right, awesome. So with all of that, Jeremy, we really appreciate you coming on the show. Can you just give the listeners a little bit more about your background and how you got to where you are today?
Absolutely. Yeah. Thanks again for having me on, guys. I really appreciate it.
Thank you.
Absolutely. So what I would say is that my story on the investing side goes that, it's 2002, and I'm actually working at Disney headquarters in Burbank here in California. I live in LA. And the dot-com crash had just happened. And I was sick and tired of the stock market for two reasons. One is kind of more obvious than the other, though. So the more obvious one is the volatility. So I'm a really low-risk guy. And to watch the market go up and down 30% a year, just not for me. But the thing that bothered me even more, honestly, was a lack of predictability for my own long-term wealth and retirement account. So not knowing where the stock market would be in a year, 2 years, 10 years, 20 years, that bothered me the most. So what I set off to do is try to find a different way to invest that would be, I would call more predictable, and be better fit for that predictability. And so what I came across is the concept of passive investing in these alternative types of investments, most of which I focus on is real estate, but there's other stuff too. And I concluded if I focus on the lower risk, kind of more occupied, stabilized commercial real estate, which includes multifamily to me, larger buildings, then I could get more predictability in terms of what that's what I was looking for. Right. So I started to dabble in those types of opportunities back in 2002, and then fast forward to 2007, and at that point, I'd actually rotated all my money out of stocks and bonds into cash flow. But I did not intend on leaving the corporate world. In fact, I wanted to have the W-2, the paycheck, and the cash flow, just to have more of that predictability on my retirement side. But I had a last straw moment in the corporate world with my manager, actually at Toyota headquarters, and where I worked at that time. And I decided to take a risk and leave the corporate world because enough cash flow built up to live off of at that point. So that's how I kind of started in 2002. But I've been a full-time passive cash flow investor really since mid-2007. Best way to describe me since 2007 as I'm kind of full-time looking for more opportunities to invest in. I'm hyper-diversified as a strategy. So I'm actually in over 70 LLCs right now, which probably sounds crazy to some people. But
wow.
That's awesome.
Yeah. I'm really low risk and I do it full-time. So I'm able to get into that diversification, but I've also been doing it 18 years. So after a while, you can really get a lot of diversification if you want to. So another thing we discussed just before this, which is I've been mostly on the sidelines probably since early 2017, still making investments, but I feel like all the asset classes are overvalued in my opinion. And so I'm just looking for unique opportunities from a valuation standpoint and mostly kind of waiting for an eventual market adjustment or downturn to really jump back in. But cash flow is my focus, more stabilized, predictable cash flow is my focus. And that's really what I look for.
Wow.
That's awesome.
Yeah, that's a lot to unpack there. That's really cool.
Yeah. So when you were working your W-2 job, were you saving your money to invest in these deals, or talk about kind of how you had enough money or what the minimum investment was that you say you originally started to dabble into the real estate world?
Great question. So the biggest problem I had back then, I call it a problem, but in retrospect is that let's say I want to get out of the corporate world, and I want to get a certain level of cash flow. I didn't have $1 million to invest at 10% and $100,000. I'm out of the corporate world. That was enough, type thing. So I had a certain amount saved up that I had saved up through saving money from being in multiple jobs before then. And so I took that money out of stocks and bonds and started to rotate it into this type of investing slowly as I learned. And I would say back then, which is not as common today, honestly, I could find deals at a minimum of $25,000. Today, I would say the most common minimum you're going to find is $50,000, and it's much harder to find $25,000. Yeah. So, but that was a different time. It was, a long time ago. So I was kind of putting small chunks into a number of deals. And for me, I was very lucky because when I first started, my first few deals was with lifelong friends of my family who I'd actually already known for since I was 4 or 5 years old, who had been syndicating already for a decade or two. And I was able to learn with them. So I was able to invest with them and learn from being with them much more than an average situation. I was also able to trust them much more than an average person. So I started off in that path and then eventually learned from that and kind of expanded going into more and more operators. But that's how I started. And another thing I did as well is it wasn't just the low risk focus at the time. I recognized that for me to really build a decent amount of cash flow, I was going to have to kind of not go into just kind of what I call low risk stuff. So I'll give you an example of one thing I did, what I call medium risk. A friend of mine had started, depending on how old your viewers are or listeners, before Amazon AWS existed and the cloud existed, you actually, if you were a company and wanted to have sensitive information, you had to actually go to a web hosting company who had a private network that they built up of servers that was actually like a tiny cloud that you can use, right? And you can rent. And so a friend of mine started a web hosting company back in 02 and 04. He approached me and he was doing really well. And he said, here's a lease that I have to do to lease this Dell server to build up my network. It was like a 28% interest rate. And basically the terms were a 3-year lease total. It was 50% cash on cash returns for 3 years plus a 5% buyout. And so the problem with it is that the residual at the end is very small, that 5% buyout. Then that's it, you're done, right?
Mm-hmm.
So it's a typical lease. So I actually, fast forward 70 leases later, and I had compounded for 8 years, an enormous amount of money that it turned out to be. I mean, relatively speaking, right?
Yeah.
So I did a combination of stuff like that, the more stabilized stuff, and a couple things in between. And I eventually was able to get the snowball big enough that it was more substantial. But the tricky part is that when I left the corporate world in 07, I had a mix of low risk and medium risk stuff, and I'm a low risk guy. So I had to kind of taper off the medium risk stuff over. It took me probably till 2012, 13 to really get out a lot of that stuff and rotate it into a much better mix of low risk, fully where I'd like to be, where I am today.
You were rolling out of the medium risk because you no longer had the W-2 income coming in.
Exactly. And frankly, to be honest, think about it this way. If you invested in par building, for example, and you're getting X amount of cash flow each year, at the end, you're presumably going to sell it and either make your money back or profit, hopefully, right?
Right.
You get that big chunk coming back to you at the end. The problem with the lease stuff is that it was a lot of cash flow, but if I lived off of all of it, I had nothing left.
Mm-hmm.
That's very dangerous. So I call that fully amortized versus a non-amortized deal, or a little bit amortized by paying on the loan, like a multifamily deal, where you can depend on that final lump sum, or at least a good probability you're going to get it. So for me, the dangerous part was I had to get out of those more heavily amortized deals. They're really, really lucrative, especially for compounding. And that had to happen once I was out of the corporate world and I was living off of it. I had to change my mix. That was very dangerous.
Yeah, that makes sense. That's insane though. 50% cash on cash. That's really, really high. I mean, in theory, after 2 years, you're essentially made whole. Is that how you looked at it?
Yes.
Okay.
Yes. What's even crazier though, for those of you who are not familiar with compounding, if you put it on a spreadsheet and you take, let's say, a 10-year horizon and you do that cash on cash for 10 years and reinvest every penny back, you would not believe what it comes out to. Yeah, because it adds up over the years.
Absolutely.
That was the key. The key was doing a lot of compounding in it.
Yeah.
So
wow.
what was the initial investment that or lease that he asked you for?
Yeah, so I'm trying to remember because some of the leases were I call it a lease, but some of them were multiple machines, some were individual machines. And actually, it's been a while since I've even I have QuickBooks and I can pull it up here, but I can't remember how much the machines, the servers were. I wouldn't want to give you guys the wrong information, but I feel like they were maybe 3,000 to 5,000 each, but sometimes it was a bundle of a few machines, sometimes it wasn't.
Mm-hmm.
And then it would, but 70 leases later, it adds up.
I can imagine it does. That's insane.
Absolutely. I have a buddy that is he's gotten me to put some money into cryptocurrency stuff and the mining rigs, and he's telling me about the returns that these things make and all of that. And this guy's really sharp. He does this full time, and it's unbelievable. And I was like, wait, so you can buy a machine for $2,000 and you make all that back the first year? I'm like, okay, this is kind of a no-brainer to me. So I've dabbled. That's another one of those things that obviously is high risk, but it's fun to do with a little bit of money. So
yeah, But I would say the common thread though is that like high risk, high reward, right? If you're going to do something high risk,
Yep.
it's going to be high reward, right? And that's kind of
Absolutely.
what you did, what I was doing. And so I
Yeah.
actually really don't do that stuff anymore. Like as far as I'm really low risk focused, I got to where I needed to be more from like a total capital perspective that I was able to get to, not worry about really compounding as much. I still a little like I have some ATM machines and I've had them since 2008. And frankly, they've honestly, they've averaged about 35% a year. So that's been good.
Unreal.
But
that's consistent too, even with like credit cards and online paying and all that.
Yeah, actually what happened is that it started at about 39, 40%. And so I'm going to put the 2008, because I started in 2008. So I went through the dip. It probably lost about 15% in revenues at that point during the last downturn, and it came back up. And then what's happened is that I've kind of like, so I say average because I'm now at about 32 to 34% on a given month. It's actually variable. It's not a fixed return. So it depends on the number of transactions. But, but I've gone from about 40 or 39 to about 32 to 34. And what that difference is likely is, and these are not all in the same location anymore. So it's not a really fair comparison. But on average, you might say I'm losing about 0.5% return per year in like probably reduced cash usage. But I don't, it's not really perfectly correlated because these machines have all switched locations over time. So
So
yeah, that makes sense.
The whole I've known about ATM investing, but I don't know. Talk to us a little bit about what are you investing in? Are you what is, if let's say a sponsor comes to you and says, "Hey, I've got this ATM machine," or what are they presenting to you, and what are you basing your decision to invest off of?
Sure. So first thing I'll say before I even answer that question is I do not recommend ATMs in general. And this reason is because if you go online and search ATM Ponzi scheme, you'll find a ton of them.
Oh, wow.
Okay.
I will tell you that since I first invested with that first sponsor back in 2008, I tried to find another deal, came close to a couple, but I literally successfully pre-identified in advance. Like when I looked at it, I looked through 3 different deals and I said, these are all Ponzi schemes. And actually it was correct. They were literally broken up as Ponzi schemes by the government after the fact.
No kidding.
One of which was one of the biggest Ponzi schemes inside of California at the end. And so I looked at it in 2009. They broke it up in like 2016 or 17.
That's why you do your research.
How'd you, what was the tell that made you realize that?
Yeah, I'll tell you the bigger one and what the tell was. But in general, just note that the reason why ATMs tend to be kind of think one of the easier, like one of the more common ones is both because the returns are high. So it attracts investors, which is really key. And because there's typically a lot of assets involved. And so if somebody says they have 500 ATMs, are you going to go spot check them all? Are they really there? And not realistic to do that, right? So you got to watch out when there's more assets because it's easier for them to pull that off. But so I'll tell you what happened with the tell, so the bigger one happens to be that this operator was located in LA, a 20-minute drive away from me. So first, I got this from somebody who was already in it, and they sent me a summary, like in bullet points on an email. So I said, "Can I get the summary, the overview, the documents?" And they said, "Well, there aren't any, but I can put you in touch with the operator." So I talked to the operator, said, "Can I get the business plan?" He's like, "Well, we've been doing this for 10, 20 years, and they actually have been doing it over 10 years." And he said, "We just don't have an updated business plan." I said, "Okay. Can I get the operating agreement?" Right, which as a passive investor, that's the rules of the LLC that you're investing in. It's very important. He said to me, "We don't give those out until you decide you're going to invest." I said, "Okay," which is kind of weird, but I said, "Okay." Then I said, "Well, can I log into your machines?" Because, with the current operator I've invested with, and I've actually now invested in a larger fund as well, like this year. But at the time with that investor, I was able to log in and see all my machines real time and look at all my transactions real time. And he said, "No, we don't allow that," which wasn't too much of a flag because if you're taking on a lot of investors, you have to pay for the account login. So I can see why if someone had 500 investors, they're just not going to allow that, right? Then I said, "Okay, well, if you're not going to let me log into the machines to verify they're real, then let me come to your head office and let me check out your machines on your computer. You're going to be logged in." They said, "No, we don't do that." That's where I said,
flag.
No documents, won't send me the legal documents, right? And won't allow me to come to their office to look at their machines. That was okay, that's a problem.
So were you just like, "Okay, thank you for your time," basically?
Yeah, that was it. And I got it a few times since, and I just ignored it basically, and eventually got broken up. I think it was like a $200 million Ponzi scheme, roughly.
Wow, that's insane.
Yeah,
wow,
going on for 10, 20 years. Yeah.
Yeah. So going back, talk about your first deal. Was that in multifamily?
My first deal was actually not a multifamily. I've invested in a whole bunch of multifamily. I'm going to guess over 20 deals at this point. But my first deal was, I'm trying to remember the exact first deal. It was either office or retail, because that first software I invest with, that's what the two asset classes they focus on, they had the experience in.
Got it. And how did they approach you? What did they say? And you had already been doing your research before that, I assume.
Well, so that was a unique situation because those are lifelong friends of my family.
Right.
So in fact, they didn't approach me. I approached them and said, I want to learn, what are you guys doing? Like, I want to get into these types of deals. And I started to look at some deals they'd done in the past. And then I started getting, when I'd have a deal, I'd get a deal and take a look at it with them. So, I had to learn that stuff from scratch, which is very hard to do, obviously.
So how many deals did you have to look at before you were comfortable with investing?
So, man, it was like 18 years ago. So that's a good question. With the special situation I had, because it was lifelong friends of my family, I tested with a couple of their deals right away. I don't think I necessarily didn't invest, and I didn't really understand how to filter properly at that point anyway. But I also knew that they were extremely conservative like me, and I knew I could trust them on the operations and just the knowing them side. Right. So it was not a normal situation. It wasn't like I had to start from scratch, go out there, find deals. It was a little bit different, These days, I'll filter I couldn't tell you how many, but I filter especially now with market pricing, it's like I pass on almost everything. So
yeah. So that first deal, how did it do? How long was it held? If you remember this information.
Yeah, it's like if you give me a sec, I can actually look up which one it was.
Yeah, that'd be. I just want to hear about that first one and how long it took from cradle to grave.
Yeah, because I'm sure once you receive your first distribution check, you're like, "Wow, this is actually real." I haven't focused on this one bit since it's been acquired.
I thought I had easy access to it here. I don't, and I don't want to delay you guys, but
no worries.
Yeah, but what I can tell you is that the first deals I invested with them, they've all done perfectly fine. They've probably either at pro forma or slightly higher. And the one thing I have learned though, which is office and retail. Now, office is different than retail, obviously, but retail strip centers is mostly what I did with them. And there's a lot of pros to retail strip centers, but both between the retail environment that's occurred in the past few years with Amazon and internet becoming more common, as well as what I learned from office and retail is that I have like a tier 1 and a tier 2 type of asset class that I focus on now. And it was from my learnings about what gives the most and not quite as much predictability of cash flow. And I'll give you guys some examples. So I look for predictable cash flow. So for me, apartments that are highly occupied in the right area with projected continued strong demand. Mobile home parks, they have the lowest turnover rate of any major asset class I'm aware of. Self-storage, if they're really diversified in a strong demand area, just the diversification and stuff, people tend to stay for a while. And then in the right locations, especially for the next 10 years, senior living facilities with the aging population, there's probably going to be a lot of them are going to be full for a long time. Those 4 are my tier 1, okay? And I think they're probably easy to understand, right, as to why there's probably a lot of predictability. In the tier 2, you have stuff like retail and office. So retail, the problem with retail is that if a tenant moves out, unlike an apartment that you can turn for a few $100 if there's not major damage and you can turn it pretty quickly, retail, you're going to have tenant improvements that weren't foreseen. You may or may not have reserves to cover those, and some of that may have to come from cash flow, right? And so because if you have non-projected turn of tenant, which can happen, that can affect your cash flow, whether it's in year 3, year 7, year 6. And for someone who's looking for predictable cash flow, that's a challenge, right? Furthermore, some spaces are better used for certain things with certain tenant mixes and everything else. So replacing the tenant can take a while and the cash flow can be gone. Also, not just from the tenant improvement costs alone, but the gap in it. So an apartment building and you got 200 units and one person leaves, you're going to fill it, presumably. That's not the case in retail, not as easily. In office, it's a similar problem with the tenant improvement costs. If someone leaves or downsizes, that space may or may not conform to the right size for someone else left. There's going to be tenant improvements that you're going to have to negotiate that may or may not have been budgeted properly, especially if it's unpredicted. So it's a similar problem. And of course, with office and retail, they are potentially more exposed to the cyclical nature of the economy, depending on where they're located, compared to a mobile home park, for example, which works well in the downturn. So I have since shied away from both of those asset classes, what I call tier 2. So it's going to take like a very unique situation for me to look at those compared to the more predictable asset classes, for example.
Got it. Makes sense. Is there a tier 3?
Well, I don't invest in hotels, and that is because the daily rate changes literally every day. So,
Okay.
and they're definitely they've had a lot of challenges with Airbnb in a lot of areas since 2008. So they've lagged in terms of increase in value in the past decade compared to most of the other major assets. So just stay away from those. Industrial can be really tough for me because industrial is often a single tenant or a very small number of tenants, and I love tenant diversification. So that's a challenge for me. And also industrial tends to be more of what I call like a vanilla box. And the problem is that when there's a downturn and there's vacancy, that rent can fluctuate a lot because you're competing against other vanilla boxes. You've got nothing special, right?
Yep.
And they all tend to be clustered in a similar area. You've got not much of a location advantage. So I tend to stay away from industrial. I've done a few deals, but it's going to take a special deal for me to do it. What else? Well, we didn't really talk about student housing. I'm a little bit concerned about student housing compared to regular multifamily. So that's just student multifamily apartments. There's a lot to like about them in certain locations, but with the advent of less people going to undergrad and grad programs now, just numerically, as well as especially some of the smaller schools that are more prone to potentially close in the next 5-10 years because of financial challenges, because they're butting up against like tuition limits. And who knows if student loans are going to be available in the next 5-10 years like they have been. I would be very careful with those. And that's something I probably wouldn't look at for predictability. Again, it's like thinking far ahead of what's predictable, and that's less predictable. So that's another one that I would be very careful with, for example.
Yeah, that makes sense.
So Jeremy, let's say somebody's listening right now, they're like, well, I'm working, I've saved up a fair amount of money. I thought maybe I was going to buy a car with it or buy a house, but this sounds really great. What would you tell someone who thinks becoming a limited partner or passive investor is a good idea, and kind of the pros and cons and what to look out for when making that first decision to invest?
Absolutely. So yeah, I'll go through a bunch of stuff, and feel free to stop me if I ramble on too long because it's a big topic. So first thing I'll say is that before you start, besides educating yourself and learning, that's like step number one. I would say step 0 is it the right fit for you? So some people are perfect for passive investing like me. I don't mind giving, I consider myself a passive investor in that I give up control in exchange for diversification. I can put small pieces across a lot more deals. I'm giving someone else control. I don't have to do the work.
Mm-hmm.
Okay. That's the benefit. The downside is that some people don't have the personality to actually be passive because they're not okay with giving up control. Okay. And that's question 0. Step 0 is, are you the right personality for passive investing? Right. And make sure you think about that hard, because what I like to tell people is that if you go down the passive investing path, you go into 1, 2, 3, 4 deals, and you stop and say, oh man, this is not the right fit for me. I don't like the idea of getting control for whatever reason. I want to backtrack. I want to go down. I want to step back and start down the active path. Okay. The problem you have now is twofold. One is that you're not diversified across enough deals. So now you've got increased risk being in these compared to someone who's properly diversified across asset classes, geographies, and operators, for example, right? 4 deals isn't going to do it. And number 2 is that it's actually illegal for you, for the SEC, to sell your shares of an LLC, to resell them in the first year, in my understanding. And then after that, it can be very hard to sell your shares. You may have to find someone to buy them from you. Sometimes you have to sell them at a loss. And it could take a few months per the operating agreement rule to actually effectuate that transaction. So it's very illiquid, right? So you can't go onto a stock screen and press sell. So just make sure you take a lot of time at step 0 and make sure it's the right fit for you before you go down the path, because it's hard to reverse from the path. Okay, so that's kind of point 1. Very important.
That's good info,
Yeah. Point number 2 is you have to learn, and you got to really understand what you're investing in. And I would say that the combination of learning and about how to evaluate an opportunity, in addition to learning how to figure out who you're making a bet on. The making a bet on someone, to me, is actually more important, who you're actually betting on, than the actual property itself, right? So the property is extremely important, but who you're making a bet on is hugely important. I like to give the very quick example that you can invest. I live in LA, and there's Beverly Drive, Rodeo Drive, really well-known street, high-end, right, stuff, internationally known. I can invest in the best building on Rodeo Drive that's 100% occupied in the best location on Rodeo Drive. But if the manager runs into the ground, doesn't manage it properly, we're going to get the keys back to the bank, we're going to get foreclosed, I have nothing.
Right. Doesn't matter where it's located.
Doesn't matter where it's located. So to me, who you're making a bet on is number 1, and the property is number 2. And until you can really get a handle on how to evaluate both of those, I would stay on the sidelines and try to learn. For a lot of people, this is a multi-month or even sometime year or 2 process to really learn. Okay. After that, I would not recommend anybody, and I'm not a financial advisor, I should have said at the beginning, so anything here is just my perspective as an investor, but I would not recommend going down this path unless you're able to divide the pie into enough slices that you're actually going to be properly diversified. Now that's subjective, right? There's no rule as to what the best diversification is. But
right.
Yeah, I've had many discussions with investors over the years, and I've kind of concluded that a lot of people like to be in at least 10 deals, maybe 20 deals, right? Whatever that number is for you, if you only have $50,000 to invest today, and you can only afford that for the next year or two, this may not be the best move for you if you're going to be in one deal, right? You're not going to be diversified properly. So if you have a plan that you can take $50K a year for the next 10 years and you're going to go to 10 things and you're going down a diversification path, okay, as long as you stick to it. But, it's the more money you have up front to be able to diversify right away, the better, because you've got to be diversified. You've got Ponzi scheme risk, mismanagement risk. I can go through a ton of 1% risks about like building burning down,
Right.
Insurance doesn't pay, you have to go sue them for 5 years and you lose, and now you're out of money from the court fees, and like you haven't gotten money from your building. So I can give you all kinds of scenarios, right?
Right.
You got to be diversified. So those are some of the things I would just caution everybody of to begin with on what to think about, just to start.
Yeah, that's good. Speaking on that, can you give us the best deal you've done and the worst deal you've done?
Yes. So for either of these, do you want them to be non-startups? Because
let's stick with real estate. Yeah.
Okay, because I dabble in startups. I've lost all my money in startups, and I've also
startups.
done
That's
crazy,
par for the course, right?
Yeah, I've done crazy returns in startups too, and they're fun. But I that's like 1% of what I do. I'm in a handful of them. So
yeah.
Okay, so let's see. You're talking about best as in best consistent cash flow, best overall return.
Let's do best cash flow.
The best consistent cash flow I've gotten, we're going to put those leases aside because they're not typical. They're not low risk.
Right.
The ATMs are my best consistent cash flow, over a 10-year period, that 35% average annualized return I mentioned.
Okay.
It's all been cash flow. So,
what about an apartment deal or an office retail?
Okay.
Yeah.
Best consistent cash flow. Let me think about, I'm in so many deals. Let me think about this.
It's a good problem to have.
Yeah.
You can't
what
think
I would
of
say is that just a generic statement, because I have to really look at my entire list.
Sure.
But, mobile home parks, okay, back in like when I started investing in 2010, it's very different now. The cap rates are very different. But
right.
Back then, you can invest in a 10 to 13 cap deal, and you can leverage it with like a 6% loan or whatever the loan was. And you could be in as a passive investor making, mid-range 15% type cash flow returns every year, and pretty low, in 100% occupied, pretty low risk situation if it's managed well.
Mm-hmm.
So I've been in some of those. And so because most of the other asset classes were a little bit lower cap rate, so I can maybe get like 11, 12, 13 consistently, but not up into the mid-teens.
Okay.
So, and some of the self-storage I've done, because you can really push rents in self-storage, you can get into like the high teens if you're like 5 to 10 years into it. But when you can say consistent, I think of it from the start even. That may have started at like 9, 10%.
Yeah.
Those returns, though, it's very important to note today, you're listening to this. Interest rates have come down just structurally over time. Those returns are not really as doable anymore because people are willing to pay higher multiples for properties because the interest rates are lower. So the total returns are not quite what they were, and those are not realistic returns today, just for anybody listening to this.
That's exactly right. That is exactly right. So what's the one of the worst deals that you've done focused on real estate? So
can I tell you a 3 or 4 minute story that is the only foreclosure I've been in, which actually did not work out that way, though. That's why it's so interesting.
And I think that's a scary word for a lot of people, foreclosure.
But this is such a great story because it's so odd and unique, and there's so many lessons from this. So 2008, January, I am personally convinced we're going to have a downturn. I've been on the sideline since early 2005 as a general philosophy waiting. And I go into this 100% occupied 303 unit student housing property with a very experienced operator. They had 17 buildings, I think they owned. And we were the first property across from a state university campus.
Are you able to say what school it was?
Yeah, absolutely. Well, it was in Ypsilanti, Michigan. So I think it was like either University of Michigan or anyway, it was in Ypsilanti. So for those of you who live in Michigan, you'll probably recognize what I'm talking about. It was a big university.
Well, I'm an Ohio State guy, so that's why it failed. It was Michigan.
Oh, there you go. There you go. Yeah, but it was not
Okay.
University of Michigan in Ann Arbor. It was not.
Oh, okay. I got
No,
you.
it was in Ypsilanti, and there's a school there that's quite large. I'm just forgetting the name, blanking on the name.
Oh, I'm sorry. I thought you said that name was the name of the actual property. So
no. Ypsilanti was the city it was in.
gotcha. Okay, never mind.
Ypsilanti, Michigan. So anyway, we're the first property across from campus, great location, 100% occupied. So I'm like, my thought process at the time was, we're actually getting, it was a unique deal. It was a loan assumption. We were getting someone out of a loan, had 4 years left, and we negotiated a good price as a result of it. And my theory at the time was that people go back to school during economic downturns. This is actually going to hold well in the downturn. And it actually did. It was perfect. Theory worked. Okay. So we were 100% occupied every year, pretty much, right? 2012 comes around, and spring, our loan is due in the fall. We're 100% occupied. There's going to be no issue refinancing it. Okay.
Yep.
We brought up rents over time, no problem. Letter goes out from the city to us and all the tenants, and it says, listen, we got to do repairs on the bridge to school this summer, but don't worry, like, we have to do it when it's warm, but don't worry, it'll be open for when, like, school's open in the fall, right? So some of these people are like, okay, can I really depend on the bridge being open? What am I going to do if it's not open? So we go from 100% occupied to 65% occupied. Okay?
Wow.
Now, that alone was probably manageable. It was borderline for, like, the debt covenants, and where we'd probably break even. We'd be very close call.
Yep.
That wasn't the problem, actually. The problem, and this is like a plane crash, like multiple dominoes have to fall, right? So that is the first domino. Domino number 2, the loan was due that fall. If the loan wasn't due that fall, we wouldn't have a problem, because we have to go refinance the loan. And the problem is that it's 65% occupied.
Oh.
The net operating income isn't supporting the refinance to be able to pay off the previous loan,
Wow.
right? That was domino number 2. But domino number 3 was the fact that the bank wouldn't extend the loan for a year because they wanted the property, probably, because the bank knows that we're going to be 100% occupied next year. No problem, right? So they wouldn't extend the loan. So domino number 3 is gone. We get foreclosed. And the operator actually had a partial recourse loan. It wasn't fully non-recourse.
Ooh.
So they came out of pocket a lot of money. But here's what's really interesting and makes the story very interesting and unique. So that would have been it. That was a foreclosure. It is what it is. I got a few years of cash flow, probably at about 10, 11% or whatever it was, right? I probably had half my money back, and that was that. But
so you didn't lose it all.
No, I wouldn't have lost it all because I had cash flow for years, right? That's the great thing about cash flow.
Right. But I'm saying your capital in it. Did you lose all of that?
Yeah, I mean, so here's what happened, actually. So I would have lost it all because it would have been foreclosed, and that would have been that, right?
Right.
So the operator, though, we went back to talking before about who to make a bet on, right? So the operator says, I feel really bad for these investors. They were actually a very wealthy operator. They actually owned some of their buildings without even taking on investors. And they said, this is like, we feel really bad. So they actually, without any legal obligation, proactively, voluntarily transferred everyone's money that they had equivalent from this deal into another deal they own in Texas, first property across from another state university in Texas. And so that took about a year. There was no cash flow during that time. There were some legal issues that they had to work out, and accounting issues and tax issues. But I'm still in that deal today that they transfer me into, right?
Wow.
So I didn't really get foreclosed because I'm now in this other deal.
That's awesome.
Scenario. Right. So but there's a lot of really good lessons there. Okay. So lesson number 1 is that there's always 1% risk. That's why I said it earlier in the podcast. I can give you stories about 20 ways a deal can go bad. And I call them all 1% risk. They're very low risk. This was a very low risk, right? Nobody can predict this. But that's why diversification is so important. That's why I'm hyper diversified. And that's why I stress that if somebody's going to start down this path, you've got to get diversified. Okay. So that's kind of point 1. Learning number 2 is that who you make a bet on is key. And what I was very lucky with is that I actually made a bet on someone who had 2 important characteristics. Number 1 is that they were wealthy, so they could afford to do this. Number 2 is that they actually, as a personality, chose to do this. You can have all the money in the world, but there was no legal obligation for them to transfer us, right? So it was that combination of things that happened that actually saved me as an investor. And that comes back to who am I making a bet on personality-wise, right? Number 3 lesson is that you got to always look at the loan and what's the situation with the loan. And one of the things I typically look for these days is a longer term fixed rate loan for predictability, right? So a 10-year loan sounds great to me, fixed rate, because I have 10 years of predictability in the way that I invest. The challenge we had here is we had a 4-year runway when we took over this loan, right? We bought it in 08, it was due in 12. And that was that was my fault in not analyzing the situation and saying, am I comfortable with this or not? Like, I wasn't sophisticated enough to even understand to consider that back then, right? I may have been okay with it had I been sophisticated enough back then. But the point is now, you can say, okay, I'm going to look at a 10-year loan. If somebody approaches me the 4-year term, I'm going to seriously consider the potential repercussions.
Right.
This was still 1% risk within that scenario, but I should have been more aware of that, right? But a great lesson. So there's other lessons too, but really, weather risk and other risks that can come up with things. But this was just, I'm sorry it took long for the story, but it's just such a unique
No,
situation.
that's all really good. Really good
the only
info.
foreclosure I've ever been in 18 years.
Yeah,
Oh, wow.
but that's things that people don't think about happening. Like you said, that 1% risk, that 1%'s there. It still happens.
Yeah, that was. I mean, that sounds almost like an act of God. Just all that crazy stuff happening. Yeah. I mean, that is so rare. But such a good point about you only had 4 years of runway, and all of that. So
yeah, I want to add another point to this, which is really interesting. If you think about plane crash taking like 5 things going wrong for the plane to finally crash, right? Because there's redundancy in the systems, and it's not usually one cause, right? So in the way that I invest for kind of cash flow, but more predictability, therefore kind of the lower risk of the rung, the cool thing is that you have to have normally 3, 4, 5 dominoes fall, which means that the probability that I'm going to be okay with most deals I invest in is higher because the risk is lower and the cash flow is more likely to come through as a result, especially because of the high occupancy rates and the types of markets I invest in. So that's another big part of the story, right? Like, I have the benefit of having to have multiple dominoes fall. Whereas, like, if you're going to invest in a development deal that has higher returns because it's higher risk, only one thing could go wrong. For example, liquidity can dry up from the banks in a downturn, and then you can't get cash and you're done, right? So that's one thing I really love about the low risk side is that usually multiple dominoes have to fall before you're really out.
Yeah, that's a great point.
Very true.
So before we get into I'm sorry, what were you saying, Brandon?
No, go ahead, Will.
No, I was going to say before we get into the moments of truth questions, what are some of the things that you're doing now, and how are you? Just what is your vision moving forward for what you want to invest in and all of that?
Absolutely. So I have been mostly in the sidelines since early 2017. Kind of with the way I work when I invest in a cycle, because I kind of go through a cycle, is that I tend to try to stay away from what's hot. And so to me, like, asset classes that get too expensive become hot, and I just stop investing in those and continue with the rest. So what happened is that the last one that I was comfortable with until end of 16 was mobile home parks, and they got too hot. So since early 17, I've been mostly on the sidelines, waiting for an eventual market adjustment or downturn. In the meantime, what I do proactively is, even though I'm a tiny investor in a deal and a very small percentage of the vote, I tend to lobby my sponsors and say, look, this is a great time to sell. Let's lock in the prices. Prices are really high. Let's lock in the return. So I've actually been in over 25 sales in the last 2.5 to 3 years, being really diversified. And so that's one of the things I've been pushing, and I'm still pushing. There's actually I got 2 sales hopefully going to close in the first quarter of next year, and still pushing on some others. So because I really want to be in a position where once the reset happens, I can just start from scratch on a lot of these. Some things I'm not worried about. I mean, many mobile home parks are going to do fine during a downturn, for example, apartments, some other stuff. So that's one thing I'm focused on right now. I'm also focused on trying to find unique pricing in the deals that I invest in, or they just don't make sense to me right now. And then looking out 5 or 10 years, I'm trying to usually look about a 10-year horizon. It's a combination of looking at the demographic trends. Like, for example, the number 1 and 2 states in the U.S. that are projected to have population increases in the next 10 years are Texas and Florida, just statistically. So that's the aging population coming south, right? So I've been looking in some of those areas and which asset classes make sense in those areas to capture that. Senior living is a great example, right? So I'm actually very heavily trying to find some senior living deals. They're very hard to find. Most of them are development deals, construction, because the forecasted increase in demand for those types of units. Right. Finding stabilized deals is much harder. So I've been looking for those, continue to look for those, focus on those tier 1 asset classes I mentioned for more predictability for the next 10 years. And always reading. I read about 1 to 2.5 hours, maybe 3 hours a day of news, trends, trying to stay on top of what I call avoiding the landmines of what's going to come up in 5 years, 7 years, right? I don't want to be the guy that invested in the Best Buy retail center 10 years ago, and now it's just a disaster, right?
Right.
So I just use it as an example. People can understand it, but
generally, or the Blockbuster.
It's a Blockbuster. That's a really good one. And so, like, I'm thinking about stuff like literally self-driving cars. How's that going to change demand patterns for certain asset classes?
Right.
the internet and less people buying stuff online, what's that going to mean? Office
Yep.
buildings, the potential demand could change because people are telecommuting more and more. There's even going to be flying, Uber, within 10 years, probably rides in these larger drones, I suppose. And how is that going to affect patterns and where people are going to want to live, for example? So I'm just constantly thinking of the evolving technologies and what I have to be careful with, as far out as I can.
That's awesome. That's all good stuff.
And it's a great thought, but also kind of a scary thought to think about, 10 years in the future and what's in store. So
and it just, as we get the technology matures, things are just moving faster and faster and faster.
Absolutely.
That's right.
It's crazy.
So,
That's right.
well, Jeremy, we're going to jump into our Moments of Truth segment here. It's the same 7 questions that we ask all of our guests, and some of them are prompted before with what the questions are, but we know you're not, so we're excited to hear what you got. So, who is your success role model?
I wouldn't say I have one per se. One person I really love to follow is Sam Zell. If you're a real estate investor, there's 2 reasons why I really like him. He is really well known for being a master of timing, when to buy and when to sell, which I think is so critical. Timing is so important in real estate, how you buy, how you sell. And he also, if you watch any of his videos, you'll see that he just tells it like it is. Like if you watch him on a panel, and he's an institutional size, he's a huge investor, but he has his own firm. And if you watch him on a panel, you'll have like 3 other people, and they're kind of like having to be politically correct in what they say because they're either a publicly traded company or they're worried about what they're going to say. They're going to get fired. He just tells it like it is. I love listening to him.
He just says no filter.
No filter. But it's like no filter combined with someone who really knows what they're talking about, and
that's
really
cool.
That's what's really cool. So I love listening to him. There's many others too. I love, Rich Dad Poor Dad and Cash Flow Quadrant book from Robert Kiyosaki. Strongly recommend those. There's a whole bunch, but yeah.
Sam Zell. I'm going to write that down. What's your biggest success?
God, that's a great question. I should have got these in advance. So
sorry about that.
I'm just kidding. Actually, I don't like getting in advance. This is much more genuine. So my biggest success, I think, is probably building up my cash flow snowball. That's my number one focus. That's what I think about for the next 10, 20, 30 years. And the fact that I've been able to stay out of the corporate world from it for 12 years running, some of which was in like the Great Recession, I'm pretty proud of. But I would say like, I'm never really content. So I don't even call that a success because to me, like, I think I'll be a success in 10, 20, 30 years. So you're making me answer the question. I'm giving you about as good an answer I have. But.
No, that's a great answer. And that's, we've gotten similar answers in the past where it's like, I don't think I've had my biggest success yet. And I love that answer. So that's good.
So Jeremy, as a passive investor, what does a typical day for you look like? And I'm sure people think, oh, he doesn't have a real job. What does he do?
Yeah, he sits around and reads the paper all day long, right?
Yeah.
No, if you can believe it, if you go click on my schedule and I have one of those, my first available date right now is in about a month and a quarter.
Wow.
So
that's why you don't have. On that note, I get to explain why you don't have the questions ahead of time. It's because you were so busy that we had to book this months in advance, and our calendar link didn't go out that far. So he's not lying.
Very true. Yeah. So what I do all day and why I'm so busy is I've kind of over 18 years now built up a really large network. So the hardest part of my day is finding opportunities. So I do a few different things to do that, right? I'm building a network. So I'm constantly talking to other similar investors to trade opportunities just to brainstorm, talking to other operators looking at deals, and then potentially talking to investor groups who may have deals, for example, or like I tend to co-invest sometimes with those investor groups in my group. So those are typically the 3 things I'm doing in a day. I have a lot of scheduled calls, talking to a lot of new people. A lot of those are just individual investors. So just continuing to build up my network.
Very cool. Very cool. What's your favorite quote?
Well, I'm not sure I have a favorite, but the first one that comes to mind for sure, and just a philosophy, is, be fearful when other people are greedy and be greedy when other people are fearful. That's that timing that I mentioned. And timing is so important in real estate. And that's why I'm on the sidelines right now. And so I think that may be Warren Buffett, by the way.
I was going to say, that sounds like Warren Buffett. He always says, sell when others are buying and buy when others are selling. Yeah.
It's the exact same philosophy. And I could not agree with it more. It's something that causes, I've been sitting on the sidelines for about 3 years now, and it's extremely aggravating for someone who's trying to generate more and more cash flow. But at the same time, I think it's the right thing to do, and it keeps me out of trouble. And so I really could not agree with that philosophy more. And that's how I choose what to invest in a given part of the cycle.
Yeah. So, I mean, if you got a deal where you knew the sponsor, you trusted them, and it looked really, really good, I mean, are you still not going into it?
No, not right now. Not if I don't
Oh,
agree with
so
the cap rate.
you're just 100%.
Yeah, no, I mean, I still invest in things, but just it's such a smaller amount of volume that I would normally do in a given year.
Okay.
And so, and the reason is because I don't believe in the multiples people are paying right now. I don't believe in the prices they're paying based on those multiples, which is
Pretty wild.
Yeah. So I'm just waiting for the cap rates to reset, the multiples to reset to where I'm more comfortable with those.
Yeah.
Very interesting. What are some of your hobbies?
Well, I love spending time with my kids. I try to do that as much as possible. They're currently like 12 and 9, and they're both boys. I play a bunch of sports with them. I'm a big car guy, to be honest with you. And it's like the funny and aggravating thing about being a car guy is that like the key to being a successful full-time passive cash flow investor is low overhead. So, I want to go buy a Ferrari and yet it's like the last thing I should be doing, right?
Right, absolutely.
That's hilarious.
But that's what you're making the money for, right?
Yeah, I love cars. I worked at Toyota headquarters, GM headquarters in the past. I'm a car guy, so I definitely love cars as well. I work out every day. That's one thing I always do, just to be good for my body and stuff too. So
cool.
Good stuff.
Well, when you do buy that Ferrari, send us a picture because
yeah,
love to take a look.
I've been trying to get myself to I own one car and I never owned more than one, and I've been trying to buy something used for a long time, and I just can't get myself to pull the trigger on it. I just feel too guilty.
Yeah, I hear you. What's the best business book you've read?
I would say that I didn't read it in advance. I read it after employing all these things. But especially if you're relatively new, strongly recommend Rich Dad Poor Dad and Cash Flow Quadrant by Robert Kiyosaki in that order. And I read both of them. The second one is a little bit repetitive for the first one, and they're both a little bit slow in the way they're written. But the philosophies can truly change your life if you're in the corporate world right now.
That's right.
Yep, excellent books, and it's a common theme. A lot of people are say that book, and it's for a reason. So,
but I recommend you read the second one, Cash Flow Quadrant, as well. I usually hear people talk about Rich Dad Poor Dad, but Cash Flow Quadrant kind of adds another dimension to it, and I think it's important to read that one too.
It's the whole mindset shift.
Yep.
So, last question here: if there was one key piece of advice you could leave our listeners with about achieving success, what do you think it would be?
I'm going to give you two. I'm sorry. One is just, take things slow and learn before you jump, but don't never jump, right? You got to dip your toe in at some point. Yep. Number two is cash flow. And I don't want to sound like an infomercial, but cash flow has just changed my life, right? It got me out of the corporate world. It allows me to my son's at home sick today. As soon as we get off this, I'm going to go see him. It just completely changed everything around for me. You're talking to someone who was climbing the corporate ladder in the corporate world at huge companies for over 10 years. Wharton MBA, I went down the typical career track. And so if you're not familiar with cash flow investing and you never thought about it or looked into it, I strongly recommend looking at it. I really don't want to sound like an infomercial, but it's completely changed my life, and it's learned about it.
Yeah.
As Grant Cardone says, cash flow is king. So it really is. So Jeremy, how can our listeners get in contact with you?
Yeah, sure. Best way is through email for me. So my email is jroll, JROLL, @rollinvestments.com, which is ROLL investments with an S.com. So jroll@rollinvestments.com. Don't hesitate to reach out to me if there's anything you want, any way I can help you. If you're new to investing, experienced investor, I'm happy to, help or network. If you've got deals, I'm happy to look at them. If you're an investor group, I'd love to talk to you. So I'm just open to networking with anybody, and I'm happy to help anyone.
That's awesome. Great. Yeah, obviously Jeremy is a wealth of knowledge here, and reach out to him if you have any questions. If you're thinking about starting to get investing or just whatever you have, reach out to him. He told us before the show he loves to help people, loves to talk to everybody. So make sure you reach out to him. And for our listeners, don't forget subscribe to the show so that way you're not missing any of our episodes and Multifamily Mondays. And join us on Facebook at facebook.com/groups/wealth junkies. Jeremy, we appreciate you being on today.
Yeah, guys, thanks again for having me on. I just hope that this was helpful for whoever's listening.
Absolutely.